Ladies and gentlemen, and esteemed guests, welcome to our Insight Forum 3, Embracing the Green Shift in Sustainability Adoption. Today we have representatives from the finance, the policy, and energy industries in our panel. We will delve into the complexity of this sustainability journey, where we will discuss strategies in terms of how the companies can employ and meet regulatory requirements and achieve their sustainable goal at the same time. So together with our panelists, we will explore the interplay between policy, investment, and industry players driving the green shift. So our esteemed panelists today represent three critical sectors. First is from the banking and financial sector. We have Mohamed Nazri Omar. He's the Managing Director of Bank Pembangunan. Nazri oversees the corporate and investment bank, focusing on advancing green and sustainable finance, supporting Malaysia's transition to low-carbon economy. Representing the policy advocacy, we have Ms. Anjali. She's the Director of Policy, Asia Investor Group of Climate Change. Anjali is the key figure in shaping AIGCC's regional and international policy agenda. And from the industry player perspective, we have Tham Chee Aun and Chai Jia Jun, who will share how companies are navigating the challenges in financing and investment. So Tham is the founder of and CEO of Ditrolic Energy, with a regional renewable energy company. He has over 14 years of experience in energy transition, solar, and renewable energy field. To date, Ditrolic has successfully developed and owned 450 megawatt of projects in various countries. And JJ is the Chief Strategy Officer of Yinson, and Yinson is an energy infrastructure technology listed in Malaysia. And they are behind some of the visible green technology business such as Charge EV. So JJ was part of the management team who oversaw the start of green investment across renewables and green technology for Yinson Group itself. So to set the stage, I'd like to start off with a broad statement. Sustainability adoption is no longer an option. It has become a necessity for all businesses. Initiatives like the National Energy Transition Roadmap, NETR, the EECA, Energy Efficiency and Conservation Act, are adding pressure to business to comply with the current or future green regulations. With this context in mind, I would like to hear from our panelists. What are some of the issues we see in Malaysia's green transformation journey? Maybe I start off with JJ first.
Hi, good morning, everyone. Thank you for posing that question. I think as a corporate operating in Malaysia, actually we operate as a global company. You just mentioned NETR, and then there's all the other frameworks, right? TCFD, TNFD, the whole alphabet soup. The worst thing I can get on a Sunday is when my team calls me and say, "Oh, here's a new framework." Then the only thing that crosses my mind is OMG, right? So many things to comply with. But I think the direction of travel is clear. We believe that as a corporate, we have no choice, but to follow the direction of travel, and we have shown our commitment by investing in both renewables and green tech. So I think for us, we have set our net zero and carbon neutral targets, and we have started putting money, not just putting targets, right, behind what those targets that we have put.
Anjali?
Hi everyone, thank you very much for having me at this panel today. It's quite a privilege. I think just in terms of responding to this question, I'd like to just take a step back to think about why there is pressure on businesses to really sort of transition. We're at a global precipice in really thinking about and responding to climate change related issues. Scientists have identified that there are global tipping points a number of which will be inevitably crossed if we don't sort of stick to that 1.5 or under 2 degree pathway. And if we don't sort of stick to that, there will be huge impact on human lives, on animal lives, and everything that we know as of now. So there is a definite sort of momentum that needs to be set to help us get to that 1.5 degree pathway, which is what we're all working towards as policymakers, as businesses, as finance. And so what we will see in the process is that once you realize that there are these huge risks and opportunities associated with climate change, there will be first movers. There will be leaders in the market that move to seize opportunities. And then there will also be laggards in the process. So now what regulation does is multifold. So firstly, it sort of enables that the entire market is able to sort of move forward and deal with the laggards and sort of get them to also seize the opportunity and move along and not have to deal with the risk themselves. We will also see policies that sort of create that enabling environment for that entire market, which we're seeing across the globe. We're seeing countries set green deals, which has started with some economies, but now are spreading to the entire sort of markets as we know right now. I mean, the reason that they're doing this is to sort of help the market seize the opportunity associated with the flow of capital to support their ambition. We're seeing policies that, when there are policies that are committed to, we're seeing the flow of billions and trillions of dollars of capital to actually help support their trajectories. They were also seeing that these policies create jobs. So for instance, the Inflation Reduction Act has already resulted in millions of jobs of creation already, and is projected to sort of result in 12 billion jobs in the next few years to come. So there's a huge opportunity as well that's there to be seized. I would just say that in terms of how regulations develop, it should not be in isolation of the community, right? There really needs to be stakeholder engagement in the way that regulations develop. And I think that's the solution to break that pressure barrier that we're seeing right now. So policymakers really need to engage with the business community. They need to engage with the financial institutions to ensure that you are able to keep up with what is coming. And we're seeing that happen in a lot of markets across Asia. You're creating these stakeholder engagement forums where you're able to actually understand what is coming and prepare the markets to actually deal with these incoming regulations. And I think that is quite important. I will stop there.
Thank you, Anjali. Tham, your view in terms of industry player?
Yeah, good afternoon, everyone. So, our view is that from our company as a practitioner perspective, our company is green and green is our company. So, we are not feeling stressful because we are in the first place in this business because we are green. So, we are not just green by saying we are green. Our company, Ditrolic, is actually Article 9 fund company under SFDR. For those who are in the European crowd in the audience, you will know Sustainable Finance Disclosure Reporting Article 9, which is a company must be only adopt to green product as their business. So that is our company. So we are by constitution, our company is a green company. So we on our day-to-day basis, we provide solution for our customer to help them to achieve their green ambition. So that also we see that it's quite interesting to see customers. They are quite stressful sometimes, right? Because they have ambitious target to get to net zero. Some of them as early as 2025, some of them 2030, some of them taking a bit slowly, 2040, 2050. So we are on a daily basis holding our customers' hand, helping them to achieve those journey. So there is a bit of stress, but I think it's a very meaningful journey for them.
Nazri, from the bank perspective, I know I know the answer will be like, oh, it's good business for the bank, right? But but that's not what I'm looking for. I think we just want to bring up some of the issues that you see within the market, whether is it from the financing perspective, the loan provider, or the recipient as well.
Sure. First of all, Assalamualaikum and a very good afternoon. Thank you very much to the facilitator as well as the promoter for arranging this. This is a time, interesting times, right? You would quite rightly pointed out that the last few years we've seen such a confluence of frameworks and policies. Never have we seen so much come out at the same time in the last 2-3 years. So to answer your questions, whether, first of all, are we stressed? No, we're not stressed. We're also looking for opportunities to help the companies. Stress, there is good stress and there's bad stress, right? And I'm going to try and make it a little bit more interesting since it's almost 4 o'clock in the afternoon here. The question should be, is it enough? There are a lot of policy frameworks that has come out and set aspirational targets, 2050, 2030. The question is, do we have enough clarity in terms of the roadmap, how to get there, and the milestones that needs to be set? I know the government and the regulators have to take a little balanced approach. They have to take into account the private sector, they have to take into account the social, and so they have to leave it to a certain extent laissez-faire, let the market decide how best to move. But I also tend to poke a little bit here and say some things, especially the regulated sectors, the government may have to set some milestones and standards. And then the companies all have to work towards that milestone and time frame before it's too late. Because if you leave it too open, then everyone's going to wait and see who moves first. And the first mover advantage can be positive, but can also be detrimental. It costs a lot more to have the first mover, and someone else is just going to leapfrog. So are they going to decide? No, they're going to wait and see as well. So how fast you want to move in certain sectors, especially the regulated power, water, and all these regulated industries. You have to have some roadmap with enough time frame for people to adjust. Agreed. You have to get the feedback from others. But I think that this is something we need to set. And because as a bank, especially Bank Pembangunan being a developmental financial institution, we want to support the government policies. But then when the client comes to us, we don't know whether this is the right time to invest in such. Can they get the payback before it's too late? So a roadmap to some extent, to me, I think is something useful for us to plan.
Thank you. So the roadmap concept is really good because I think we have just embarked on our sustainability journey for the last 2 to 3 years, right? I mean, the feedback is that we talk about alphabet soup. We talk about stakeholder engagement, and I think all of us do agree that this is a journey. It's not an end point. In fact, it's the starting point to a very interesting journey. But before we get to our end point, I think one of the things that I want to really talk about is where do we get the fuel for our journey to start, right? If you look at sustainability, there's a lot of investment that is required. So I would like to touch on the first topic, which is access to capital and investment decision. Malaysia has a very ambitious vision in achieving the net greenhouse gas emission as net zero as early as 2050. The vision calls for a rapid transformation of the country's energy landscape, and in terms of the country's energy mix, we target to achieve 70% of renewable energy capacity by 2025. So, and when we look at all these big numbers, the associated capital or investment required is immense. We're looking at an amount of 637 billion in terms of capex investment. And this is something that I would want to discuss on. So the next question that I have is for our banker in the panel, Nazri. Could you start us off by discussing how's the banking industry adopting its lending practices to support the green transition in Malaysia? And as a banker, how do you balance the need of economic development with sustainability goals in your financing decision?
Especially that last question is the most important for a developmental financial institution. Well, first and foremost, to answer that question, the generic answer that cuts across all the banks in FIs in Malaysia is, of course, they're getting ready. You hear a lot of the banks have announced their ESG framework. This is of course voluntary, but also driven by investors that requires them to do so. From our regulator, Bank Negara, they have also had the foresight as early as even before COVID itself. They came up with guidelines for the bankers to classify climate risk, categorize them, so that there can be some form of mapping out how much climate risk that we are taking as financial institutions. So this climate change taxonomy came out and helped us to classify which one is a transition financing, a company that's in transition, which one is polluting, which one is helping tremendously, right? And that's what all the banks have started doing. And we are getting prepared because the next thing the regulator is going to do is in the next few years ask us to stress test. What happens if you have a drought? How much of this classification is going to impact in terms of turning into bad loans, for example? So the banks are getting ahead of the curve. They're doing that. They're also doing, as you can see in the booths outside, some banks have already come up with specialized schemes for specific type of financing related to sustainable EV financing and so forth and so forth. So they're preparing in that regard. For Bank Pembangunan, because we're a developmental financial institution, we have to balance not just from an ESG point of view, but also the developmental needs of the country. So this is no easy task. This is a balancing act because, as you rightly pointed, environmental, social, governance all comes into play. But is it at the expense of development of the country? Does that mean we don't finance any oil and gas projects now? Stop, right? I know the controversial with coal-fired power plants, right? But if the country really needs the coal or needs the power in the coal to a certain extent, does that mean there's a totally no-go? So that balancing act is important. So at Bank Pembangunan, we realize with all these conflicts, there must be a way for us to synthesize and analyze and come to a decision whether we want to finance a specific project or not. So as early as 3 years ago, Bank Pembangunan with the World Bank, cooperating with World Bank, we come up with a framework that we call Measuring Impact for National Development. It's important to come up with this framework to incorporate the UNDP Sustainable Goals, as well as the Rancangan Malaysia ke-12, RMK12, goals and objectives into this framework. So what it is, in summary, is a series of questions, a scorecard, if you may. So we ask our clients who comes to asking for a financing, is your project doing this? A, doing this? B, creating jobs, and so forth and so forth. And all these questions is to address the UNDP social inclusivity, sustainability, and also the government objectives in terms of economic catalysts. At the end, you get a score. If the score is above the threshold, then we finance. If it's above the threshold, we consider financing it. If it's below the threshold, we don't even look at it. Even if it's profitable, even if it makes perfect sense from a return, from a financing point of view, and it's low risk, but it is not having enough economic impact. Why? Because Bank Pembangunan also has limited capital. As you rightly pointed, we have to spare the capital to where it does best, most impactful as much as possible. So once the score is above the threshold, then we look at the bankability and the credit evaluation. You cannot run away, and we have to do that part as well. But at least the MIND framework addresses the balancing act between environmental, social, net, it must be positive. Positive, negative items must end up in a positive score at the very least. So that's one way we are addressing the need to balance these things.
Thank you. That's a very good insights. I think now we would probably want to take a look on how to get to the scorecard that you have, right? It's a very structured way of doing it, which is good because otherwise then it will be very difficult in terms of assessing the economic impact that will come through from the financing. So thank you, Nazri. So from next, I would like to turn to Anjali. From policy advocacy standpoint, what are the key policy trends shaping sustainable finance in Asia, in your view? And are they effective in driving transformation in Asia? And how do they compare to the global standards that you have seen?
Thank you. Just so I don't end up speaking through this entire session in terms of policy trends that are important, I might restrict my remarks to perhaps the top 2 to 3 policy trends that's quite important in driving the sustainable finance flows into Asia. So I think the first one is discussed quite a bit through the day. I think data is the most important factor that really will work towards helping us diagnose what the problem is, also looking at possible solutions and also assessing the credibility of these solutions. Also, as sustainable finance is becoming more mainstream, the risk of greenwashing, as I'm sure we've heard about it over the course of this day, and generally, data transparency really helps in sort of building that accountability and transparency in terms of performance. And I think the markets in Asia are doing really well in sort of, moving the needle on disclosure standards and mandating it. Several markets, including Malaysia, Singapore, across Asia, they've already sort of mandated and are phasing in disclosure standards. I think Malaysia is sort of really doing a good job in creating also platforms that makes this data accessible to the public, to investors, to really help them understand the market better, thereby also opening up the market to newer investments in sustainability. And so I think the disclosure trend is one that is quite fundamental sort of going forward for sustainable finance. One trend that's also complementary to disclosure is transition planning. We see, institutions like the Transition Planning Task Force was set up in the UK to really help create standards on how companies and financial institutions can create credible transition plans, which is sort of an instrument that will enable a company to communicate effectively to the world on sort of what their transition strategy is in response to their climate targets. It's really important for companies and investors to really sort of be clear about how their asset structures, their business strategies will change as a response to their transition plans. And sort of demonstrating that clearly through transition planning will drive more credibility into the finance that will flow into a company and into projects. So I think these two trends are quite fundamental. When you have good data and when you have a clear transition plan, things like ancillary policies like taxonomies will really spur the movement in attracting sustainable finance to sort of where it really needs to go. And then a third pillar would be on sort of national policy, right, or state level policy. I think this sort of came up in questions, during the course of the conversation today. So having a clear national transition plan or accountability in terms of the way the government looks at approaching climate change is quite crucial as well. So in the Malaysian context, the climate change bill would be quite instrumental in actually showing the market level commitment to what they've made in terms of like a global, commitment on climate. It will really build market confidence and sort of attract more investments into a market that is very clear in terms of what its ultimate objectives are and how it plans to achieve it through clear short-term, medium-term, and long-term planning. So I think these would be really sort of what drives sustainable finance flows.
Thank you, Anjali. Your perspective on the policy and financing is crucial to understand the broader context. Next, I would like to move to Tham. Tham, as an industry player, do you think the banks, regulators, and investment communities are doing enough to drive this green shift?
Yeah, I think I can comment specifically in terms of energy sector, in particular electricity, which I'm practicing in. So I think to answer your question, yes, I think all of them are very participative. The banks are very supportive. Since we first started doing our first lending, first borrowing 10, 15 years ago compared to now, is much different from 15 years ago. So the banks are much more willing to finance energy transition projects compared to last time. And now whenever you win a project, the bank will start calling you instead of you calling the bank. So there's no doubt about that kind of support the bank have. In terms of policy regulator, I think we have seen the government setting very good and significant target. We have seen many big policy framework that came out, NETR, and things that similar things that came out, and we see subsequent program being rolled out. So in that perspective, I think they are doing very well, and the capital the market is also very participative. The investors' interests are at all-time high, and it can only get higher because of all the excitement that everybody has in terms of this industry. So while everybody is very participative, I think the key questions is, are they aligning to each other? Whatever they are doing, is the policy aligned to the capital market? Is the capital market aligned to the banking sector? I think this is one crucial question. Government can introduce a very ambitious program, whether it is the best program for the banks or not, or for the investors. So while it all seems very good on the surface, but I think the devil is in the detail, which I think we can explore, dive deeper and explore. So for me, there is three fundamental elements for energy sector, especially renewable energy. The challenge. One is technical challenge, second is a policy challenge, third, capital challenge. So technical, Malaysia has seen a surge of renewable energy projects, at least on the project that are being awarded. So currently you see that Malaysia, we have very little connection capacity left in the grid. So there is a need to look at how we are going to inject further electricity into the grid. So this is one challenge that from a planning perspective, right? Second is from the policy perspective, what is the challenge? While they are very supportive, I think the policy challenge is sometimes the alignment between the policy and the requirements of the investor is a bit different. For example, I think there are some policy that restrict ownership change in Malaysia for power plant. Let's say there's a moratorium, long moratorium. So this also present a challenge to asset owner, whereas Malaysia need 1.8 trillion of investment until 2050. So we need a lot of capital to mobilize to build plants after plant after plant. So people can't hold on to plants for very long, right? While the intention is good, but it actually restricts liquidity in the equity market. So the problem in Malaysia actually is not debt, it's actually equity. As I say, the bank is very, very supportive. But for every $8 or $7 that the bank provide, the investor have to provide $2 to $3. So the problem is this $2 to $3 is stuck in the old asset. So how do you release this money and turn the project into maybe say a pension fund, maybe EPF or somebody else, to have it with a low risk, low return, and then you free up this capital for the developer like us to reinvest into a new plant. So I think this is the alignment that I'm talking about. So there are things like this and a lot of topic of how we are going to invest in infrastructure, what is the best optimized way to make it not affecting the general public, the price of electricity, while we are investing in grid, investing in battery at the grid. So how do we most optimize, in the best optimized level, invest in this kind of infrastructure? It's both a technical question as well as is a policy question as well. So this is my view.
Thank you, Tham. So just to take your point, Tham, in terms of the capital as well as the equity issue here, I want to move on to JJ. Your viewpoint from an oil and gas company, which typically operates with high level of financial leverage. What strategies do you employ to reassure banks and investors about the viability and security of taking additional debt for your company? One. Number two is that how do you ensure continued support and financing from these stakeholders in light of the industry's evolving landscape? What strategies can we implement to de-risk this project and attract more equity investment?
So, coming off what Mr. Tham said earlier, we are actually an energy transition company. Our origins are in oil and gas infrastructure. So the equity part for the projects in green, we have from our brown business. So very unlike a company like his, which is a standalone green business, we have equity coming in, which funding the transition from our brown business. We have set an internal target for 30% of our equity at minimum to be invested in green by 2030. That's the 30% of a very big equity base, right? And in terms of availability of capital, what we are finding actually is there's no lack of capital. There's different pockets for brown, there's different pockets for transition, there's different pockets for green, right? In the last few years, we have raised about 1.2 billion ringgit in terms of sustainability linked finance or green placements, right? That is at a corporate level, putting aside project financing. So these money have actually all been plowed as equity, right, into our green projects. So I think some of the issues here is really availability of capital. Capital is there. Ronnie just said you just have to get through that checklist. So now I know how to get money from Nazri, sorry, right? Now I know how you score and I know how to get your money. So capital is there, but there's sometimes a mismatch in terms of what is required and what is available. We, for example, are now in touch with a couple multilateral financing agencies. But when we speak to them, they come to us, JJ, minimum size, 40 US. Otherwise, I don't think it's something I want to take to my investment committee, And then you can talk to another bank and they also come to you and say there's minimum sizes. So sometimes there's a mismatch there in terms of what is required, right? And what the banks make available as well. In terms of making sure that we have continued access to capital, I think it's about engagement with stakeholders. So we spend a lot of time reading through all the commitments that our major shareholders made in terms of climate transition, energy transition, emission targets, any other commitments that they sign up to, right? And try to map our transition following them. And then we also study all the banks that fund us. What are the commitments they make? When are they going to drop off oil and gas funding? How much is the pool of capital available for green? And then from there, from that mapping, we know which banks we can target and which banks we can push, right? So, but partly because of the size of the business that we have built from our conventional business, that makes us a little bit more bankable, right? And that also makes banks more comfortable to lend to us. So when we do have a green project, we typically have a long queue of lenders and funders behind that. So I think capital is available. The Malaysian market capital markets is actually very supportive. At least that's the experience that we have had.
Thank you. So the next point that I want to move to is about mobilizing capital and optimizing investment for the climate projects, right? We recognize that this is a unique challenge. It requires a lot of investment. Climate projects often require upfront investment and the return may not be very immediate or apparent. This brings us to the question about in terms of cost versus value, right? So Anjali and Nazri, I will open two questions to both of you. What strategies can be employed to mobilize private capital for climate adaptation projects, which often present less clear financial returns compared to traditional investment? And the other question is that how do investors balance the cost versus value in their investment strategies, particularly when they consider the long-term projects of sustainable projects? Yeah.
I can start?
Yeah, sure.
Okay. So, the organization that I work with, which is the Asia Investor Group on Climate Change, it's an investor network. So we bring together institutional investors, so like the big, pension funds, sovereign wealth funds, life insurances, and asset managers, and we work with them on sort of really understanding and responding to climate change related issues. There is an annual survey that AIGCC produces to really understand how the investment community is sort of responding to climate change related risks. So the most recent report that we produced this year assesses how about 200 investors that manage over 76 trillion USD in assets are sort of responding to climate change related risks. And what we found is that 82% of the asset managers that were surveyed and 50% of the asset owners have publicly sort of made some statements about the impact of climate change in the way that they will operate and have committed to sort of make some sort of change. Out of these, about 52% have actually started integrating climate change into the way that they make investment decisions. Now, just sort of moving to this, I think that's quite important to sort of look at how the investment flows will change and how investors are really assessing these risks and opportunities associated. It is a big movement that will really influence the flow of capital. I think just sort of moving on to the adaptation question, I think that's a prime example of sort of how you look at costs and how you look at value. So I think there is an inherent perception that, adaptation and resilience is something that needs to be publicly funded. There is no role for private capital there. But I think what we're seeing amongst investors is that you're really realizing the exposure of your assets and your portfolio in markets in Asia specifically to physical climate risks. The impact that these sort of physical risks will have on returns is quite huge. And so what you see on the corollary is that when there is an inherent risk that's on the horizon, what you will see is also that there are going to be solutions that emerge that can actually fill these gaps. And we're actually seeing that. There is a survey that was done, a study that was done by MSCI, other institutions like Bezos Earth Fund, Gary, which really looks at public companies and how they've pivoted their businesses to really create resilient solutions that can be financed by investors. So there is a real opportunity as well that can be seized, and not everything needs to be seen as cost, because there are ways to sort of convert those costs to value creating propositions that investors are actively looking out for. And there are enabling sort of instruments that policymakers and other stakeholders can really create to enable that. One of those fundamental policies would be the national adaptation plans, which a lot of regions have developed, and Malaysia is in the process of developing. What a national adaptation plan can do is to sort of really create that understanding of what the physical climate risks are in terms of exposure, but also look at what the solutions that need to be developed to bridge those risks. So I think there are multiple ways to sort of look at this and create value for investors in a way that you also get returns.
I think you mentioned a great statement there that sustainable financing has to also depend on private capital. But because private capital has to have some returns, you cannot run away from having some economic returns. Question is whether what is high enough. It has to be sustainable. So what is high enough? And when it's less clear of the returns in the near term and future, so that's when investors hold back and see whether it's worthwhile to do this or not. And bankers also hold back because to see whether you can get paid in the next 5 years or 10 years. So this is where I think the developer or the promoter, together with the regulator or even the government authorities and the bankers, can be a little bit more creative. Think out of the box. And this is not something going to be new. Even in Malaysia, 15, 20 years ago, we have built an infrastructure that not only solved one problem, but solved another problem at the same time. This is, for some of you guys who've been traveling back and forth in KL, the smart tunnel, stormwater management. That's a climate risk adapting infrastructure. At the same time, it's not tolling people for the storm drainage. It's tolling people for moving the cars in and out. So you're finding other source of revenue to address the risk, to address the climate risk issues, for example. And so need to think out of the box. I've seen also projects which have its problems, but the idea is there that the payment is in kind, not in terms of return from you're building a flood mitigation issue. How are you going to get return from that, for example? Right? You're doing something to preserve the forest, for example. How are you going to get return from that? But maybe there's an ancillary income, payment in kind, as I said. You have heard, and there are things such as land swap. The government has land that they want to develop. They don't want to just sell it and make money. They can do that for the developers to take the risk and develop some public infrastructure and in kind get the land as payment. Of course, the land has to have a commercial value. It has to be something that they can turn into a profit eventually. It's a matter of timing. So how then do banks, and especially development banks, help in this regard? Tenor. How long can you stretch to ride out the short-term volatilities? And so for development banks such as Pembangunan, we look at financing up to 15, 20 years, for example. Some banks can do up to even 15 years already today. We've seen that as well. So those is the ways that you have to think out of the box and look at the tenor that's sufficient enough so that you get enough return and pay back the lenders, capital providers.
Thank you. Actually, there are a lot of questions that I want to ask the panelists today, but I was told that we're running out of time. Yeah. We will move on to taking the Q&A from the floor. But just while we wait for the participants to reach out to the mic, I just want to take the opportunity to touch a little bit about just transition. Yeah. As we know, when the shift to the net zero emission, it will impact a lot of lives. Just from the International Labour Organization, it's estimated while the transition will result in a loss of 6 million of jobs in the energy sector. But on the flip side, it will also create 24 million of new jobs by 2030. So that's the number that we are targeting here. So the question is that in terms of the just transition, how does industry player like Yinson or JJ, you look into this area on how you approach and implemented the change that you have encountered, and how do you ensure that the low carbon transition is inclusive and equitable for all your stakeholders?
I mean, we started as a logistics company. We moved into oil and gas infrastructure. We have a lot of stakeholders in terms of lenders, equity investors, and one of our biggest equity investors is EPF, right? And just like them, I mean, shepherd us. Don't just give us the stick and divest, right? Tell us what is your roadmap, what is your transition plan, what are your targets, what do you want to achieve. So I think we adopted a similar practice in terms of a just transition. We are zooming into our scope 3 emissions, right? Understanding what are our vendors contributing in terms of our scope 3, right? And with that, we are bringing our vendors, big and small, along on the journey, right? Towards meeting our climate goals and on a just transition. So I think that's one of the examples where we are bringing our vendors along on the journey on this energy transition.
Thank you. I think we have a question from the floor.
Hi, Arena from EY. I think the first thing is I want to applaud. There has been quite a lot of advancement in financing the energy transition. And as you rightfully pointed out, even for UEM, Agenta and Hillary, I want to applaud is when you find good solutions like energy efficiency, you start to provide microfinancing. And that takes away capital from the bank and you may be competing with the bank. So that's good. But when we talk about adaptation, there's a huge concern and what's rightly pointed out, the solutioning is actually still not scaled. So the question then is, how targeted are we every time when a climate crisis happens? How good are we in pricing climate disasters? Because we always say that, someone has to pay for climate disaster. But who has those data sets by geography? Who is actually paying for it, like Bandar Baru Klang? And the question is, if there is a task force like JC3 looking at physical risks with all the financial institutions, are we going down to the ground and identifying adaptation every time when a flood risk happens? And what are the solutioning year on year we're building up in that repository? And how financing is coming as we look at subsidy reform? So that's my question.
Thank you, Harina. It's a very good question. Anyone wants to take it, Nazri?
If you want to talk about financing, pricing the cost of financing for climate risk, the short answer is not yet. And the reason why it's not yet is because we don't have enough data. But it's working. I've seen people who have shared some data to show like the heat map in Malaysia where the rainfalls are, where the heat wave is more, and things like this. So that gives you some idea. If you're going to have a project there, if that's going to be factored into your risk profile, then maybe that can be factored into the risk pricing. It's a start, but it's not there yet. That's the short answer.
Can I come in as well? I think just in response to your question on sort of who's going to pay for these climate risks that's manifesting, is like if we don't change our approach in the way that we're looking at the impacts of climate change, it will be everyone that pays for it, right? Like there is no framework in place that would actually help us effectively respond to these risks. You would think perhaps insurers, right? You insure your house, you insure your cars, but now insurance is becoming really expensive. Insurers have the data of how physical risks will manifest. And the pricing of insurance will go up for areas which is exposed to higher exposure to physical climate risks. But that system needs to change. There has to be an effective mechanism to actually help you deal with physical risks when a majority of the areas that we sort of live in across Asia have high exposure. It will affect businesses, it will affect everyday lives. So we need to sort of look at understanding these risks better and changing frameworks across the board to really help us actually factor in these risks and respond to it effectively.
Yeah, that's very good. I think the question on who is paying for it, probably we can't identify who should pay for it at this point in time. That's where we probably need the regulators to come in and enforce it down. But effectively, if we can't find the person to pay for all this pollution, like the Sungai Kim Kim and all that, right? The society is paying for it in one way or another. That's my view. And that there is a requirement or a need for the government to come in quickly to look into all these. I think then we will be able to put some framework and structure around it. Okay, so we have another gentleman in the white shirt.
Yeah. So I guess, what we've heard is that sometimes, I guess, from Nazri's perspective, there can be a limited kind of capital or shortage of capital. But sort of from the project owner perspective, there can also be a mismatch of ticket size. So I was wondering, from your perspective then as financier and as well as asset owner or project developer, how are banks, industry and government thinking about coordination, right? One potential solution is the bundling of different projects to make it viable. But of course, this type of bundling or this type of larger coordination efforts may come with certain trade-offs as well. So I was just wondering, so two questions are, one, how are banks, industry, government thinking about coordination? Two, if there's any preference, I guess, I'm happy to hear from the investor perspective as well, in terms of sort of a more centralized approach like we see in the UK or Australia, where the governments are coordinating their national sort of investment plans for climate change, versus I think what is much more common here in across Asia Pacific, across Southeast Asia, where you have sort of pockets of activity happening from sort of maybe down to even very small projects, 2 megawatt mini hydro kind of for rural communities, right? So whether there's a perspective on centralization versus decentralization. That was my second question. Thank you.
Nazri, I think the question is meant for you.
Yeah, I'm thinking, synthesizing here. Definitely having a central database, more information is better than nothing, right? And you rightly pointed out, and I think Tham also mentioned about the equity problem. So if I know a list of potential investors who want to look for that kind of projects, say they're looking for wind farms or they're looking for solar and their return is say between 8 to 10%. And I have a client who comes and say, look, I want to do this project. The return is 10%, but I don't have enough equity. Then I can match them up quite easily. So yeah, that definitely will help. From a coordination point of view, I think this is when the regulator or whoever is the decision maker in awarding these projects, so whoever runs the tender, has to have pre-qualification, right? If you're going to tender, you make sure you have at least some financial standing to be able to come up with the equity for this. It's not just put the best proposal and later you have a problem trying to get it off the ground without the equity. So definitely that's what.
Again, chime.
Yeah.
Right. So I don't see any coordination during the bidding stage, right? I think the coordination of bundling can happen when the asset is built, right? That's why it's back to the same point that I said. The project is developed at an IRR of 10%. Let's say a bunch of people or maybe government or pension fund, they come together, they want to buy the asset at 7% IRR or 6% IRR. So they can come in after the commercial operation, they can come in and buy asset. So whether our policy allow that kind of activities or not. So you don't see a lot of this kind of, acquisition in Malaysian market in a large way. Every time an acquisition happen is a big news, right? By right, in a lot of countries, acquisitions, buy and sell is actually very normal, right? So I think we need to have that kind of, activities so that it becomes more coordinated, like probably answering your question. I think we have to get used to acquisition, consolidation from 10% IRR, somebody take it out at 8%, 7%, 6%. I think that kind of things need to happen.
Okay.
I think in the context of Malaysia, you talk about bankability. I mean, the off-taker is clearly bankable. It's a question whether the project economics at the rate that you want is that bankable, and how much equity you have to put in for the project to make sense. But I speak in the context of international projects where you can, for some developing countries, you can bring in multilateral agencies to help with the bankability. But again, it's only worthwhile for a certain size of projects. It won't make sense if you're trying to do 50 megawatts and you try to bring Asia Development Bank, for example, to come and step in, right? So again, it's a measure of size and in terms of bankability, I think in Malaysia we have a bankable counterparty.
Okay, thank you. So we have time for only one last question. I think the gentleman there has been there for a long time. Sorry.
Okay. Hi everyone. Thank you to all the panelists for your awesome insight so far. My name is Iskandar. My question is basically not economic driven much, but it summarized throughout the insight that we gained since the morning just now. The important part that we understand here is about the socio-economic capacity building involving the local capacity in that time. In the past, first and second insight so far, we heard that the local community has gained, I would say, rough times in terms of discovering new opportunities, in terms of adapting sustainability or shifting into a greener initiative in their lifestyle or maybe in their projects. Thus, therefore, since the industrial players are here, even the financiers are here, I just want to know what is the view or initiative from the industrial player itself to ensure that the local community can also produce the project that could sustain the industry and support the economic gains that will be benefited by you yourself, the panelists in front of me right now. And also, secondly, the second question, a part of it, might be related as well. I just want to know exactly from the industrial player itself, what exactly the main risk that industry is currently facing to include yourself into the green shift about sustainability adoption. Is it about merely equity, or there's some other things related to it as well? And what makes you feel like you're ready to enter the green shift itself? Thank you.
Maybe I'll attempt to take the second part of the question. We don't see it as a pressure or a risk. We see energy transition as a great opportunity. Energy transition and climate change is a megatrend that we cannot deny, right? And it's just the pace at which it would happen, So instead of seeing it as a risk for us, especially as an energy oil and gas infrastructure company, we see it as a tremendous risk, as opportunity, tremendous opportunity, right, for us to capture. We are moving early, right? So as Nazri pointed out, the question is how early we want to be. There's risk to that. We are early in a lot of spaces. We currently, Gentari might say otherwise. We run the largest EV charging network, for example, in Malaysia. Right? So some of investors would say it's too early, right? But as a corporate, at the same time, the challenge is balancing between short-term expectations of stakeholders and the long-term plans and ambitions.
Okay, thank you. So for the first part of the question, maybe Nazri, can you take that in 1 minute?
I'm still struggling to see what's the question for the first part.
I believe the question is with regards to the initiative that is available for like the underserved areas and all that.
Yeah, I mean, definitely when we look at projects, as I said, the Mind Framework Scorecard takes into account impact to the local communities. Unfortunately, our projects tends to be infrastructure and large base, so we don't do community or retail or a micro SME type of financing. But definitely we look into, for example, if I'm building a toll road or highway, we are opening up the rural areas for accessibility. So that has an indirect spillover effects for the community, and therefore they can take advantage of that for their economic well-being.
Okay, thank you. So as we conclude today's session, I'd like to thank our esteemed panelists for their contribution and their viewpoint. The insights shared today is of great importance. I think the key takeaway is collaboration and a collaborative and an integrated approach towards driving the green shift. So before I close, I would like to ask each panelist for a short answer to these questions. Yeah, just in 1 or 2 sentences. What do you hope to see in terms of transformation of innovation in the immediate 1 to 2 years? JJ?
I think on the innovation space, breakthrough in battery chemistry.
I think for me, one of the fundamental sort of things that really drives the communities to act faster is policy and regulation. And I think what's really missing in Asian markets is long-term policy to sort of sustain the momentum. And that's what I'm sort of looking for, really innovative policy to spur the market.
I think my take will be scaling up. I think we have fulfilled all the conditions mostly. I think it's time to scale up and think big.
For me, I alluded to it just now, the clarity in terms of the roadmap and faster decision making. And also to highlight for private sector mobilization, Pembangunan has dedicated schemes where we can provide interest subsidy to make these projects more bankable as well. So yeah.
Thank you. So thank you all for participating, especially those who came forward to ask questions. We look forward to continuing this vital conversation and driving progress in our sustainability goals. Have a good day. Yeah.